Hey everybody, Yasin Nizami here with another quick update on the rate hike from Bank of Canada this morning, and they announced 50 basis point rate hike this morning on their overnight rates, which means the prime is going to go up to 645 tomorrow from all the major lenders. The HELOC is going to touch upon 6.95%. And the new low variable rate is going to be 5.45%, and the median variable rate is going to be 5.95%. So this is the most aggressive rate hike we have seen since 2008 global financial crisis. And the irony is they introduced stress test back in 2020 in order to make sure that the borrower is able to absorb the shock if it happens. Now the prime is even above the stress test, which is 5.25. So it's basically a nuclear bomb. It's basically, this is the biggest rug pull, from under the Canadians' feet. So, and the Bank of Canada, they use a soft tone this time, saying that they may be able to raise another rate hike next year, depending upon the inflation data, because the inflation is still very high, over 5%, the core inflation that they look at it. And if it doesn't get down, they may be forced to raise another rate hike. And it depends upon the inflation data. So I think their tone is kind of soft. They say they may or may not, but again, it depends upon the data next year. So what's going to happen in 2023, even if they don't raise the rates, if the rates stay at that level, this is too expensive for anybody to buy real estate. It's clear as mud, because if you are a buyer and you're buying it for yourself, yes, then you live in the property. Maybe you can absorb that expensive rate and buy the property because you want to live there, right? But if you're an investor, the cash flow doesn't make sense. There is no way you will be able to make that a profitable investment decision. Don't even think about speculating the future price, because at those levels there's no chance the property is going to appreciate until the rate comes down to some nominal level like 3% or 3.5%. So I think the 2023 is going to stay like that. The property market will continue to slip down. Because in my previous video, I mentioned that you have property market and then you have interest rate. In the middle, you have the affordability matrix, which is built upon measuring the monthly payment. If the monthly payment is out of people's range, it's not affordable. It's not there is no case for a bullish market at all, right? So that affordability metric has to be better. Either the rates come down or the prices come down. There is no other way. Okay. And what I think is going to happen, if the rates going to stay at that level, the property market prices are slowly coming down, which will bring the affordability at acceptable level. And at the same time, when the inflation comes down, the rates is going to go down as well. So that will be the best case scenario in my opinion. And I could be wrong. I'm just sharing my knowledge with you. And so yeah, that's what is announced today. And I think we have to just swallow this pill, because the rates are going to be so expensive. So whoever has the variable rate mortgage in the last 2 years, including myself, we are only covering the interest. Our monthly payments are only covering the interest. I know that, but most of the people who have taken variable rate mortgage, they don't know about that. So it will be a shocker for them when they realize upon the renewal that their principal is still sitting there and their amortization has gone extended beyond the initial term. So that will be a big shocker for them. But I think we have no other choice. We have to eat that, and hoping that by end of 2023 things will get better. The inflation gonna get down, and then that will basically push central banks to reduce the rate. So this is the biggest rug pull. The people who are going to be blamed are central banks, government, federal government, because the amount of fiscal spending they did in 2020 in the name of emergency funding, pandemic funding, We are paying the price in the form of inflation, in the form of expensive rates. Yes, consumers are basically incentivized to move in a direction where they see the profit. Back then, the rates were so cheap, it was a natural instinct for anybody to take the debt and buy the assets. Nobody knew that they will jack up the rates so quickly, like 400 basis point in the next 6 to 7 months. We have never seen that happen. Rate goes up gradually, 25 basis point every quarter. Yes, that's acceptable. But 400 basis point in the next 6 or 7 months, that's too aggressive. That's a rug pull I'm talking about. So government and central bankers are the people to blame because they created this mess. And when they got out of their hands, now they're trying to make up to it. They're trying to fix it. And because the inflation is too high, they have to protect the currency, because if they don't do it, the currency is going to collapse against US dollar. So they have to protect the currency at any cost, and that is the cost we are paying for their mess. Anyway, I'm going off the tangent, but this is what we have seen today. I just wanted to quickly make this video to educate you about what's going to happen and what's happening. So let me know, what do you think? If you have any comment, put them down below. If you like it, give me a thumbs up, subscribe, and share with your friends and family. I'll see you in my next video. Take care.